So I'm actually interrupting this video's rendering process to bring you guys some headlines from Jerome Powell that just came out that you need to know about. We're also going to talk about this rail strike, or port strike, if you will, that starts tonight at midnight. And the what could be second standard deviation black swan event that we're literally starting in a couple of hours. So first and foremost, Jerome Powell says annual GDP revisions were, quote, quite interesting. He says the labor market may give a better real-time picture of the state of the economy than GDP. He does say yet again there's nothing suggesting a downturn is more likely now, even though economic data has weakened, and that would likely suggest that a downturn is more likely now, but hey, we'll let Jerome Powell have his moment. It was really these comments about the path of the federal funds rate that did spook markets a little bit, which this could actually have something to do with the port strike that starts tonight, because that could boost some inflationary pressures, and the Fed saying, hey, we're not going to be super accommodative if the economy kind of does what it's supposed to do. It could be because of some of the strikes that are supposed to start tonight. Powell says if the economy is as expected, the S&P shows 2 more 25 basis point cuts in 2024. Wall Street, just before these comments, were pricing in about a 50% chance of either 25 or 50 basis points coming in November, and now markets are pricing in a 31.5% chance of a 50 basis point cut and 68.5% chance of a 25 basis point cut November 7th. And then Jerome Powell says that the labor market is still solid, but it really has cooled. And these were the main headlines that did cause the late trading day volatility. On one hand, less aggressive cuts from the Fed potentially shows the economy is doing better than we thought. On the other hand, less aggressive cuts from the Fed perhaps could raise recession odds, because at that point we're going to stay restrictive for longer. Now back to your regularly scheduled programming. If you've been wondering why we're seeing Christmas decorations and products coming way sooner than what we've seen in the past, it could have to do with the port strike on the East Coast that is scheduled to start tonight at midnight. This is something that I have warned of as a 2 standard deviation black swan event. This could be a tipping point to turn the US economy into a recession. About 40% of goods being exported and imported to the United States goes through these eastern ports. That is over $100 billion worth of goods per month. Not to mention the tens of thousands of port workers that will go on strike. And it's expected to see shortages of bananas, booze, chocolate, and cherries if there's a long port strike, because it doesn't make economic or logical sense to ship many of the goods that come into East Coast ports by alternative ports of entry or by plane. And normally retailers start stocking up on goods for the holiday season in July through November, but they moved that up to May and June this year in anticipation of the port strike. It's also being reported that a 1-day shutdown takes 3 to 5 days to recover from. The longer it goes, the worse it gets. And unfortunately, we just don't see things like this all the time. The last major port labor dispute was an 11-day lockout of the union workers at West Coast ports in 2002. Meant that it took 6 months before things were back to normal. This could also mean more inflationary pressures on products that are, well, presumably going to stop heading into US ports by midnight tonight. Take a listen to this clip on CNBC from NRF CEO. He says East Coast port strike is the last thing the US economy needs ahead of Q4.
Now with his outlook, the impact, what he sees ahead, National Retail Federation CEO Matt Shea. Matt, good morning, welcome. So how involved are you in these negotiations from the retail side?
Well, Sarah, we're not involved in the negotiations per se. Certainly, we've been communicating with the White House, the administration, since the beginning of this year, trying to communicate that this is going to have a real impact on our economy. So as recently as this weekend, yesterday, I talked to Labor Secretary Julie Su, We regularly talk to the Council of Economic Advisors at the White House. We had a group of CEOs on a call earlier this morning and a number of them last week. And it's a concern not only because of the impact on the retail industry, but because we live in a global interconnected economy. And so whether it's retail or automotive or pharmaceuticals or food and drinks, beverages, all those things are going to be impacted at a time when we're finally turning the corner on inflation. We know that the job market and overall economic activity is moderated from the highs over the last several years. And this is really the last thing we need as a self-inflicted wound as we go into the fourth quarter of the year.
So is your position now that the Biden administration should get involved?
Well, what we've communicated from the beginning is we'd like to see the administration encourage the parties to continue the conversations. And formal discussions broke off back in June. So the parties haven't even had any formal discussions since then. That's of concern because if they aren't talking, obviously they're not making much progress. There's a political dimension to this, of course, and I'll leave that to the administration to share their perspectives. Our view is, without regards to the positions of either side, either the unions or the shippers, the USMX, we think they ought to be talking to each other and recognize that this has got a ripple effect way beyond retailers, and our members have done everything they can to mitigate, to guard against what might happen. But no matter your scale, I talked to the largest retailers in the world last week and this week and this morning. No matter your scale, your sophistication, your resources, you can't prepare for every contingency. And so as well as they may be prepared, there are others who can't prepare at all. And that's going to have a ripple effect on families, on American workers across the economy that we just don't really need at this point in our economic cycle.
Matt, maybe you can explain to viewers how order cycles work regarding holiday and to what extent holiday might be disrupted if this lasts for a while.
Sure. Well, Carl, you and Sarah know this. These decisions are getting made months and months in advance. So some of these goods have been brought in earlier. Normal peak container arrivals would be in August, September, October for the end of year season. This year we saw that pulled forward. So June, July, August, we saw lots of retailers anticipating there might be a slowdown or rerouting some cargo to the West Coast ports. I spoke to one of the executive directors of a major West Coast port yesterday as well, and they're running at 80% capacity. They've been taking goods into the West Coast, and then retailers and others have been shipping across country, but the economics come into play as well. So at some point, even if you can get capacity on the West Coast, there's some goods for which it just doesn't make financial sense and economic sense to ship across the country by rail. And if they're not here by the fourth quarter, they're not going to get sold. And I guess the other point that's worth remembering is that the way a slowdown or a stoppage works, it's not a linear process. So if the ports are closed for 1 day or 2 days, they don't recover in 1 day or 2 days. This grows exponentially. It compounds every day. With a global supply chain, just because we close down 40 ports on the East and Gulf Coast, the rest of the world keeps working. The ships keep coming, the factories keep producing, and clearing that backlog takes months. In 2002, the West Coast shut down 11 days. Took 6 months to recover from that. So any day that goes by without continuing flow of goods, I think it's going to have a real consequence for the economy.
This, I think, is something that's going to become very real tonight when you do get the port strike that starts. Most people don't even realize, even on Wall Street, that there hasn't been any communication since, what do you say, June? Between the shippers and the porters. That's not good. And I would also like to mention that this strike, this shutdown that is going to occur, will be fine throughout Q4 for the holiday shopping season. By the end of December, right before Christmas, there might be some scarcity starting to happen if the port strike is not resolved by then, which it's almost a guarantee it would be, right? But starting off the first or even second quarter of 2025, that's where you could see even more shortages. And then if there is a larger prolonged strike, companies. They're not going to be able to get things in. You'll probably see manufacturers start to slow down some manufacturing, and that can really weigh on the job market that is already in a weak place. It can weigh on inflationary pressures and overall economic activity. And again, for markets that are sitting near all-time highs, this could slap us in the face over the next couple of days, because this will have an impact on the economy, and it could be a sizable one, just depending, again, how long this strike lasts. You can also think about the potential economic effects on our economy, something like this. Let's say if you get pizza every Friday for your family, but let's say this week you didn't get pizza on Friday, you got something else. Well, next week, if you decide to get pizza on Friday, you're probably not going to order double the amount because you skipped on it last week. So if this does become something that is prolonged and we do start to see shortages and people just go without, it's not, these are not things that people are going to double buy when they come back available, right? So that becomes a problem for the producers that make those goods, because if people go without, then they're not going to sell more. That's going to be a hit to their overall business. And I'll tell you confidently, markets are not pricing in that risk as of now. That said, we did have some data that came out today. We had Chicago PMIs that came in a little bit better than expected. At 46.6, the estimate was 46.2. But it's really not that good. New orders fell at a faster pace and is in contraction. Employment fell at a slower pace but still in contraction. Production fell at a faster pace, in contraction, and prices paid rose at a faster pace, and they are expanding. So new orders are plummeting, employment has already plummeted, production is plummeting, and prices for goods and services are rising. That's not good. We also did have the Dallas Fed Manufacturing Index that came in at negative 9.0. Last month was negative 9.7, so it's a little bit better than last month, but we were expecting things to get much better. The estimate was negative 4.5, so you came in about twice as bad as the forecasted estimate. Now, tomorrow morning, you have your first set of major economic data for this week. You get ISM manufacturing PMIs. Now, this will be important on the headline number. You're expecting 47.5. Last month was 47.2. So you're expecting things are going to get a little bit better. But you will get manufacturing employment, manufacturing new orders, manufacturing prices paid, okay? These separate components will be important, and I think markets are going to pay most attention to the ISM manufacturing employment. If employment is continuing to hemorrhage in the September manufacturing PMIs, I don't think Wall Street is going to look at that as favorable, no matter what the other subcomponents of the PMI actually look like. Tomorrow morning, you will also get JOLTS job openings. You're expecting those to come in really unchanged from last month. Last month, you were at 7.673 million. You're expecting 7.67 million. So really not much of a change. If job openings come down, that's not going to be good, because right now we apparently have more people entering the workforce, but job openings that are declining. So that's actually causing the unemployment rate to go higher. So if job openings come down more than expected, 100,000, 200, 300,000, then that's going to mean the unemployment rate is likely to go up quite a bit. And we get that report this upcoming Friday. Also in the news today is a soaring Chinese stock market. The stock market in the world's second largest economy is up over 25% in the last 5 trading days, with the Shanghai CSI 300 that went up over 8.5% last night. That is following news that Chinese banks have been told to cut rates by 50 basis points on existing mortgage loans. And this is actually the best day for the Chinese stock market in 16 years. And over the course of just 5 trading days, the Chinese stock market is now in a bull market. U.S. Treasury Secretary Janet Yellen says the labor market and inflation suggest we're on a path to a soft landing. Although San Francisco Fed President Janet Yellen, which is now the Treasury Secretary, on October 30th, 2007, said this 6 weeks before the recession began. Quote, So in summary, I think the most likely outcome is that the economy will move forward towards a soft landing. I see downside risks to economic activity and some upside risks to inflation, but in view of continuing questions about the effects of the financial market shock, I am more concerned about the activity side of things right now, which is really what you're hearing from most Fed officials. They're saying inflation could be a problem. We're not as concerned about that. We're more concerned about the economy, and specifically labor market. And I'll tell you, with all these similarities to 2007, from what the economic data looked like in 2007 to what it does today, the economy actually wasn't that bad September of 2007 when the Fed cut rates. It was, again, pretty similar to our economy today. Things just went downhill quickly. At that time, it was the housing market. Some, banks that had really bad loans that caused a larger issue. Potentially a port strike could be a similar style issue if it does last a while. As I've also shared with you guys as well, I am concerned about housing markets because inventory has tripled since February, March of 2022, going from about 350,000 homes listed then to over 909,000 homes listed now, when you're seeing mortgage applications that are not really doing anything. They're down 60% from that same period in 2022. If you compress, demand's falling, supply is up, that is an unfavorable position for housing prices. And if housing prices come down, then that's going to weigh on economic activity, people's spending patterns ahead of the holiday shopping period. Kind of what Peter Burskin with BCA Research just said on X as well. He says mortgage refinancing has picked up, but mortgage applications for purchase are still dead in the water. Maybe the fact that real home prices are up more than 20% higher than before the pandemic has something to do with it. Goldman Sachs maintains their year-end price target of 5,600 for the S&P 500 index and projects the S&P 500 EPS will reach $256 by the end of 2025, which is actually a bit of a problem because if full year 2024 EPS comes in at about $241 per share, then that means the multiple today for markets for 2024 EPS at 57.10, which is about 571 on the SPY, which is where we are now, is 23.69 times. That is not a cheap market at all. And that means we're trading at about 22.3 times 2025 earnings already at the price the S&P is at. Like, how much upside is there? How much multiple expansion is really there? I don't think much. Now, what's actually starkly different from Goldman Sachs' estimate of $256 for EPS is the broader markets are expecting around $274 of EPS. So based on Goldman's numbers here, if they're expecting 5,600 for the S&P by the end of this year with 256 for earnings next year, Goldman's actually saying a 21.87 times multiple could be appropriate. If earnings do come in a little bit higher, where markets are expecting about $274, that would put upside on the S&P to about $599 on the SPY, or about $5,993 on the SPX. Again, comes back to the central argument I've been making on markets for a while. There's not much upside left. You've priced in all of the good news. Literally, if things are as perfect as possible, $274 of EPS, that's higher than even Goldman Sachs' target for 2025. I mean, that's 4.8% upside from here to get to 6,000 on the SPY. Like, I don't know if you guys think that's attractive, but I don't. Not when there's potentially 20+% downside if the economy does weaken from here. Even if you are in the super bull camp, even if you're in the soft landing camp, I don't know how you can justify that with a risk to reward 4.8% to the upside and potentially 20+% to the downside. Even if you think there's an 80% chance of a soft landing and there's an 80% chance of a 5% upside rally from here in the S&P, but say there's a 20% chance of a 20% downside, I don't think you can justify the risk to reward for markets right now. And that's why I'm concerned for markets in the near term and really over the next couple of months, the next 5 or 6 months or so. I'm concerned. Even with the port strike that is expected to start tonight at midnight, I mean, that's not factored into markets at all. And they aren't even having discussions at all. Like, it could at least shut down for a couple of days, maybe a couple of weeks. Bank of America says look out for tax loss harvesting in October. We screen for S&P 500 stocks down over 10% year to date and overweight, more likely to be sold for tax loss offsets as of today's holdings analysis. Dollar Tree, Dollar General, Boeing, Lulu, Estee Lauder, Humana, Biogen, CVS. These are all companies that could be prone to some tax loss harvesting. But then again, Dan Ives, buy-side analyst for Wedbush, says we believe the stage is set for tech stocks to move 10% higher into year-end, another 20% in 2025, with this tech bull market just hitting its next phase, led by the AI revolution. We believe the overall AI infrastructure market API could grow 10x from today through 2027. And a lot of people are delusionally optimistic right now, even though there's, again, limited upside in the S&P and potentially large downside prospects in the S&P if the economy does start to weaken further. And again, the JOLTS job openings numbers tomorrow, if they come in lower than expected, is going to be a big wake-up call for investors, not to mention, again, the port strike that starts at midnight tonight. Another fascinating aspect about markets today is the CNN Fear and Greed Index on Friday was at 67, which was yes, greed, but today you're at 73, which is close to extreme greed, even though the S&P is actually red at the time of recording this video. You can take a look here. Market momentum is greed, stock price strength, extreme greed, stock price breadth, extreme greed, put and call options, extreme greed, market volatility is neutral, safe haven demand is greed, and junk bond demand is in fear. So even though markets are red, the S&P, well, really unchanged at the time of recording this video, you're still seeing the CNN Fear and Greed Index rising a lot today. 10-year Treasury yields are also trading higher by about 1.5 basis points, currently with a yield of 3.76%. The VIX is climbing about 0.5% today and still overall elevated at 17.03. Percent of stocks currently trading above their 50-day moving average is also declining today to 64.37%, although it's a very marginal decline. Still, on average, you have more stocks breaking below their 50-day moving average today than breaking above their 50-day moving average, which is not a super strong sign. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel, and specifically let me know what you think about this East Coast port strike and what effect this will have on the economy and or our markets in the coming days and weeks ahead. You guys have a great rest of your day, and I will see you in the next one.